Jindal Steel and Power has made a new 52-week high in an environment where all the other steel stocks have corrected anywhere between 6 and 30%. Now, this outperformance in the stock price is because of higher volumes, debt reduction and higher raw material sourcing through captive mines. JSPL has secured 100% of its requirement for thermal coal over the past 1 week. As per the various media reports, JSPL has been awarded 3 thermal coal blocks. With total 4 captive coal blocks in its kitty, JSPL's mining capacity will be 15 million tons with environmental clearance in place. It's likely to incur a capex of around 1,500 to 2,000 crores over the next 12 to 15 months to start mining operations in all the 4 mines. In March, JSPL's 100% subsidiary Jindal Steel and Power Mauritius prepaid $357 million loan to its lenders. This prepayment will help clear the entire debt of the Mauritius subsidiary. This loan also had corporate guarantees from JSPL India, which will get released. Post this prepayment, JSPL has an overseas debt worth $130 million and it plans to repay $113 million by September this year. JSPL's current pellet making capacity is 9 million tons at Barbil and it plans to add another 6 million tons at Angul in Phase 1 and another 6 million tons in Phase 2. Phase 1 is likely to commence production by September-October and Phase 2 by FY24. Hot strip mill Phase 1 of 3 million tons is likely to be commissioned by Feb to March 2023. By FY24, JSPL will have 21 million tons of pellet capacity and around 13 million tons of steel making capacity. According to the management, capex spent for FY23 and FY24 is likely to be around 4,700 crores and 4,300 crores respectively. The divestment of Jindal Power is on track and is awaiting clearances from lenders. On the receipt of 3,000 crores post the divestment, JSPL will reduce debt further. It also plans to acquire shares of JSPL Employee Benefit Scheme, which will be purchased through the open market route. The trust has been allowed to buy a maximum of 2% of the outstanding shares in any year, with the total limit being 5% of the outstanding shares. ESOPs will be valued as per relevant Ind AS guidelines and fair valuation will be done according to Black-Scholes model. The difference between the acquisition cost and fair value will be amortized over the life of the ESOP. With this, free float is likely to get reduced. JSPL has 2 coking coal mines, one in Australia and the other at Mozambique. Both are operational and generated an EBITDA of $31 million in the December quarter. JSPL's total requirement for coking coal is around 4 million tons annually for its 6 million ton blast furnace. Of the 4 million tons, both the mines put together can supply up to 50% of the requirement, costing around $120 to $130 per ton compared to the market rate of around $550 to $600 per ton. In terms of iron ore, JSPL has been allotted 2 mines, Tensa and Kasia. Tensa mine can cater to about 25% of JSPL's requirement. Kasia mine was won recently at a premium. Mine reserves from Kasia is around 275 million tons and JSPL is securing all the approvals related to the commencement of the mine. We expect it to get operational in around 12 to 14 months. December quarter results were marginally above expectations. Lower volumes along with high realization led to about 10% decline in sales. EBITDA per ton remained under pressure because of higher coking coal prices. JSPL has indicated that the standalone EBITDA per ton for March quarter is likely to be around 20,000 as compared to 17,400 per ton, while rest of the steel players expect EBITDA to remain under pressure in Q4. The reason for higher EBITDA per ton as indicated is stable cost of coal quarter on quarter and higher volumes resulting in operating leverage. As per the press release, January and February recorded sales volume of 1.28 million and management has guided for 2 million tons in March 2022 quarter. As the domestic market remained subdued, JSPL resorted to higher exports with around 30% of the production currently being exported. With China reducing production and supplies from Russia and Ukraine not being there, Indian players are likely to tap the export opportunity. JSPL has taken nearly 4 price hikes to the tune of 8,000 to 10,000 per ton since Jan, in line with other steel players. Further price hikes cannot be ruled out as coking coal prices continue to remain elevated. JSPL is best placed among steel players with higher sourcing from captive mines, volume growth resulting in operating leverage, debt reduction and capex spend peaking out in the current year. Investors with a high risk appetite can definitely buy the stock at current levels and accumulate it on decline.